Welcome back to the channel. Today, we're diving into the top 10 asset classes you should consider for investment in 2025. Whether you're a seasoned investor or just starting out, this list will help you diversify and maximize your returns. Now, before we get started, I want to emphasize that this is not financial advice. Investing always carries risk, and it's crucial to do your own research and maybe even talk to a qualified financial advisor before making any investment decisions. Alright? With that being said, let's jump right into it. First up, we've got equities, better known as stocks. These are essentially shares in a company, representing ownership and a claim on part of the company's assets and earnings. This is like owning a tiny piece of your favorite companies. Think Apple, Tesla, or even that local coffee shop you love. By purchasing stocks, you become a shareholder and can benefit from the company's success. When these companies grow and become more profitable, their stock value goes up and you make money. This appreciation in stock price can lead to significant capital gains over time. There are two main ways to invest in stocks: individual stocks and stock market indices. Individual stocks allow you to pick and choose specific companies, while indices offer a broader market exposure. Indices track a basket of stocks, like the S&P 500, which follows the performance of 500 of the largest US companies. This can provide a diversified investment, reducing risk. Investing in growth sectors like technology, healthcare, and green energy can offer significant returns, especially over the long term. These sectors are often at the forefront of innovation and can drive substantial growth. But remember, the stock market can be volatile. Prices can fluctuate widely in the short term due to various factors, including economic data, market sentiment, and geopolitical events. If you're patient and have a long-term investment horizon, equities can be a powerful engine for building wealth. Over time, the market has historically trended upwards, rewarding those who stay invested through the ups and downs. Next up, we have bonds, the reliable steady eddy of the investment world. Think of bonds as loans you give to governments or corporations. You lend them money and they promise to pay you back with interest. Bonds are generally considered less risky than stocks and can provide a steady stream of income. There are different types of bonds, like government bonds, which are very safe, and corporate bonds, which offer potentially higher returns but also come with a bit more risk. Bonds are a great way to diversify your portfolio, reduce volatility, and provide a cushion during those stock market downturns. Now, let's talk about real estate. Real estate offers both potential for appreciation and the opportunity to generate passive income through rent. Directly owning property, like a rental property or that dream vacation home, can be a fantastic investment, but not everyone wants to be a landlord or has a huge down payment saved up. That's where REITs come in, real estate investment trusts. Whether you're flipping houses, renting out apartments, or investing in REITs, real estate can be a solid addition to your portfolio. Chapter 4. Commodities, the raw materials that make the world go round. We're talking about things like gold, silver, oil, natural gas, and agricultural products like corn, wheat, and soybeans. Investing in commodities is a bit different. You're essentially betting on future price movements of these raw materials. Commodities can be a good hedge against inflation, especially precious metals like gold and silver. During times of economic uncertainty, investors flock to safe haven assets like gold because it's a tangible asset with intrinsic value. Commodities can add diversification to your portfolio and potentially protect your purchasing power during periods of inflation. Chapter 5. Next up, we're entering the world of cryptocurrencies, the wild west of the investment world. Bitcoin, Ethereum, Dogecoin. These digital currencies have been making headlines and turning heads with their potential for massive returns. Cryptocurrencies are decentralized digital assets, meaning they're not controlled by governments or financial institutions. They operate on something called blockchain technology, which is essentially a secure, transparent digital ledger. Investing in cryptocurrencies can be incredibly exciting with the potential for life-changing returns. However, it's crucial to remember that cryptocurrencies are incredibly volatile. Chapter 6. Now let's talk about diversification, made easy mutual funds and ETFs, exchange-traded funds. These are some of the most popular investment options available today, and for good reason. They offer a simple way to diversify your portfolio without needing to pick individual stocks or bonds. These investment vehicles allow you to invest in a basket of stocks, bonds, or other assets with a single purchase. This means you can spread your risk across multiple investments rather than putting all your eggs in one basket. Think of them like pre-built portfolios managed by professionals or tracking specific market indices. This professional management can be a huge advantage, especially for those who are new to investing or don't have the time to manage their own portfolios. Mutual funds pool money from multiple investors and use it to buy a diversified portfolio of assets. This pooling of resources allows for greater purchasing power and access to a wider range of investments than an individual investor might achieve on their own. ETFs, on the other hand, are similar to mutual funds, but are traded on stock exchanges, just like individual stocks. This means they can be bought and sold throughout the trading day at market prices, providing flexibility and liquidity. Both mutual funds and ETFs offer instant diversification, making them a great option for investors of all levels, especially beginners. They provide a way to gain exposure to a broad range of assets without needing extensive knowledge or experience in the market. They take the guesswork out of picking individual stocks and provide exposure to a wide range of assets. This can help reduce the stress and complexity of investing, allowing you to focus on your long-term financial goals. Now, let's dive into the world of private equity and venture capital, the fuel that powers startups and drives innovation across various industries. These investment vehicles are crucial for the growth and development of new businesses. Investing in private companies or startups can offer the potential for significant returns, but it also comes with higher risks. The rewards can be substantial, but the journey is often fraught with challenges and uncertainties. Private equity firms typically invest in established companies that are not publicly traded. These firms look for businesses with strong fundamentals and the potential for growth. They often acquire controlling stakes in these companies, allowing them to implement strategic changes and drive operational improvements. Using their expertise and resources, private equity firms aim to enhance the value of their portfolio companies. On the other hand, venture capital focuses on early-stage companies with high growth potential, often in the tech sector. Investing in private equity and venture capital is typically reserved for high-net-worth individuals and institutional investors. These investors are willing to commit large sums of money due to the high minimum investment amounts, longer investment horizons, and limited liquidity. Despite these barriers, the allure of potentially high returns continues to attract investors to this dynamic and ever-evolving field. Next up, we're talking about the foreign exchange market, also known as Forex. It's the largest and most liquid financial market in the world, where currencies are traded 24/7. Forex trading involves buying one currency and simultaneously selling another, hoping to profit from the fluctuations in their exchange rates. Forex trading can be incredibly lucrative, but it's also incredibly risky, especially for beginners. It's crucial to have a deep understanding of macroeconomic indicators, technical analysis, and risk management strategies before diving into Forex trading. Hedge funds, the world of high-stakes investing, often shrouded in secrecy and reserved for the ultra-wealthy. These investment funds use advanced strategies and complex financial instruments to generate high returns, often with higher risk. Hedge funds are typically structured as private investment partnerships, open only to accredited investors who meet certain income and net worth requirements. While hedge funds can generate impressive returns, they also come with significant risks. Investing in hedge funds requires a high risk tolerance and a deep understanding of sophisticated investment strategies. Last but not least, we have collectibles and alternative assets, investing in your passions. This category includes everything from art, antiques, and vintage cars to rare stamps, coins, and even fine wine. Collectibles can be a great way to diversify your portfolio and potentially hedge against inflation. However, investing in collectibles requires specialized knowledge, research, and due diligence. The market for collectibles can be illiquid, meaning it can be challenging to buy or sell assets quickly without impacting their price. So, there you have it. The top 10 asset classes you should consider for investment in 2025 and beyond. Each asset class has its own risk profile, potential returns, and suitability depending on your individual investment goals, risk tolerance, and market conditions. Remember, diversification is key to mitigating risk and maximizing returns. Don't put all your eggs in one basket. Instead, spread your investments across different asset classes that align with your investment goals and risk tolerance. And as always, don't forget to like and subscribe for more investment tips and insights.